What's up, everybody? Today, I want to talk about something that I think is incredibly important, and most people have no idea how it works, but it is this. How do banks make massive rates of return by teaching you the exact opposite of what they do with their money? All right, so I've been obsessed with this idea for a long time because if you think about this, banks have made massive rates of return for a long time, right? We are taught to invest our money to try and chase a 6, 7, 8, 10, 15% rate of return, yet their rates of return sometimes are in the hundreds of percentages. And I want to show you how they do this by taking very little risk, okay? So understanding how the banking industry makes so much money is crucial if you want to have that same sort of impact in your life. So how do you increase your rate of return by decreasing your risk? Most of the videos on this channel are going to be about the same topic. Let's rewind. Let's look at 2008 for a second. In 2008, we saw a massive decline in the real estate market. And what happened was most Americans were leveraged. And that means that they borrowed money, as much money as they could, to go buy a house that they really couldn't afford. That's called leveraged. And banks loved it. If you looked at what mortgage companies were doing back then, they had all sorts of incentives. They had things called the 5-year ARM. So for 5 years, you paid zero to the principal of the loan, to the house, and all of your payments went just to the interest. And then in the 5th year, the mortgage sales rep would say, just refinance. Well, until you can't. The housing market was dropping in value. Mom and pop weren't making enough money. So when the refinance came around, interest rates were high and they couldn't afford the new payments. So they bought a house they couldn't afford. Now, what does that mean? How did the industry, did civilization, how did America get approved to buy houses that they couldn't afford? It's because banks run the country. Come on, everybody knows this. And they make massive rates of return. So basically they lent money that didn't exist. So think about this question. When banks lend money, so if I go to the bank and go buy a car and I say, look, Mr. Banker, I want to spend $30,000 on a car. Can I use your money? When they give me that $30,000, are they giving me their money or somebody else's money? They're giving me somebody else's money. They're not using their money. Banks go into debt all the time. Why? Because of a word called arbitrage. Interest rates. It's very easy to understand. I'm going to go over it. I want to give you an easy example to understand in this video so you can apply it to yourself. We teach this stuff in our training, the one-on-one training that we do as well, but I'm kind of giving you a tidbit so you can use this on your own. So when we look at banks and when they lend money, they're not lending their own, they're using somebody else's. They can go borrow from the federal government, or they use your money that's on deposit. Here's what's interesting about banking. They do what's called fractional reserve lending. So if they have $100 in deposit, they can lend out up to 10 times, sometimes even more, 10 times the $100. So 100 on deposit, they can lend 1,000. Not bad, huh? Pretty good. Right? $100 in deposit, lend 10 times. So when the 2008 housing market started to drop, banks lent money that didn't exist, and the economy could not pay it back. The mom and pop, they were losing their jobs. Housing prices were dropping. They couldn't go borrow more money from the bank, and they couldn't afford the higher payments. And that's why people went into foreclosure. If you look at what banks were doing, banks were allowing people to pay off their houses at a smaller rate than what was owed. Why? Because the banks didn't have money. The banks lent everything out. The banks were leveraged. Not only were people, banks were leveraged because of fractional reserve lending. They lent money that didn't exist. And now when the housing market's dropping, the bank's going, please buy the house. We know you owe $500. We'll let you buy it for $300. Now we're going to kill your credit. You're not going to be able to buy anything for the next 7 years, but we'll take $300,000 for that asset. Why? Because banks don't want to own assets. They don't want to own real estate. Kind of getting off topic. So let's go back to this idea. I want to talk about rates of return, all right? Because I think most people would think a 15% rate of return in the market would be a really good thing. But then let's compare it to what banks are getting. All right, now let's look at some rates of return. So let's go over a quick story. Let's say that I have a hammer that I bought for $9. Spend $9 on a hammer and I'm going to sell it for $15. It's pretty good, right? I made $6. Well, actually, I made a 66% rate of return just by selling a hammer. Now, what do we think is a good rate of return in the market? Let's say I had $100 this year, and next year I want to end up with $115. What's my rate of return? 15%. Now, according to the market, if I got 15% consistently every year, that would be a really good thing. But how do banks make money? So if I put $1 on deposit in a bank, how much do I make? Next to nothing. Let's say I put $1 in and I get a half a point. So 0.5% a rate of return in my savings account. So the bank is going to pay me 0.5%. Okay. So the cost for the bank is 0.5. Now, if I went to that same bank and got a mortgage, how much is the mortgage going to be? Let's say it's 4%. So they get $4 back and they give me 50 cents. So what's their rate of return? 700%. They gave me 50 cents and I give them back $4. That's a 700% rate of return. Now, if you have a car loan, what if it's a 6% car loan? That's 1,000%. Okay, follow me on this, everybody. I put $1 into the bank. They're going to pay me a half of a penny. I'm going to pay them $6 on a car loan. It's a 1,100% rate of return for the bank. But they're not paying me a 0.5%, are they? They're actually paying me like 0.1% in my savings account. Can you read this number down here? 5,900% rate of return. If you had a 5,900% rate of return, would you consider that a good day or a good year or a good business model? These are the same people that had to go to the federal government to get bailed out. What business do you know of a business that makes almost a 6,000% rate of return and then has to ask for the government to bail them out because they can't keep up? Maybe the salaries were too high. Now, what happened after the banks got bailed out? Banks get money from the government paid for by who? American taxpayer. That's right. The government doesn't make money, guys. They don't sell a widget. The only way that the government has revenue is through taxation. So the taxpayers bail out banks. And thank goodness banks came right back and said, thank you, American taxpayer. We're gonna start lending even more. That didn't happen. They didn't lend more. In fact, it's become a heck of a lot harder to even get a loan. What they did do, though, was take that capital. They got big bonuses for the C-level, the C-suite people involved in the banks. And then they took the extra money and they bought government bonds. Who pays the interest on a government bond? The same people that paid for the bailout. Meanwhile, we're trying to chase a 15% rate of return, and the banks are making a 6,000% rate of return. Now, you have to make a lot of transactions to make it actually grow, but think about how little money they have exposed. They're paying me 0.1%. 0.1%. Money is so cheap right now. So next time you hear people complaining about banks, not only can they call your loan when they want to, not only do you have to give repayment structures, not only do you have to get approved for an amount, you have to prove your income, prove your debt to income, prove you have assets, prove you have a job. Then they might give you money at a rate that they determine. This interest rate that they choose, you're going to be required to pay. So when you can start applying these principles of arbitrage is getting paid 1.1% and charging 6%. That's arbitrage between two interest rates. When you can start applying that to your money, you're going to look at wealth completely differently. So the idea of setting up your accounts so that you can lend against yourself, not take from the most expensive way to make a purchase is using your own money. We'll do more videos on that later. But right now I'm showing you the arbitrage. When you can set yourself up so that you can lend yourself money at a very low interest rate, the government will incentivize you to do it because you can deduct business loans, interest on business loans. You're gonna have to talk to a financial planner and a CPA for your specific thing. This is not recommendations here. This is just teaching you guys how this stuff works. So make sure you talk to your CPA and your financial planner before you make a decision. Obviously, you can reach out to us if maybe we can help you. But when you learn how to set yourself up just like the banks do, not only do you reduce your exposure to risk, who cares about the 15% on $100 or $1,000 or $100,000? 15% rate of return in the market is nothing when you compare to how banks make money. So hopefully you enjoyed understanding how arbitrage works, how banks make money, how to maximize your rate of return and minimize your exposure to risk. We'll do more topics on this later. If you guys like this type of stuff, leave a comment below of what you learned. And don't forget to hit that subscribe button. And we'll see you next time.